U.S. government debt is getting a lot of attention these days. As of October 24, 2025, it has reached $36.2 trillion, according to the Treasury Department. That means the debt is now 124% of the country's GDP, slightly higher than last year's 122% and the highest level ever seen in peacetime. The government now pays over $1 trillion a year in interest, which is more than the $850 billion spent on defense, and almost as much as Social Security, according to projections from the Congressional Budget Office. This year's deficit is expected to grow by another $2 trillion, mainly because of ongoing spending from the 2021 infrastructure bill, tax breaks, and leftover costs from COVID relief programs. All of this is putting real pressure on the federal budget. If interest rates rise even slightly, it could force cuts in other areas. But the US still has one major advantage. The US dollar remains the world's reserve currency. That allows the government to sell treasuries to central banks and investors across the globe, keeping 10-year yields around 4.5%. And even with the usual debt ceiling standoffs, like the one in January 2025, investors continue to trust US bonds because alternatives like German bonds or Japanese government bonds come with their own problems and offer much lower returns. Switching to China, the picture looks more controlled on the surface. The International Monetary Fund, IMF, in its October 2025 World Economic Outlook, estimates China's general government debt at 88.3% of GDP, up from 84% in 2024, but still below the US level, and far from Japan's 236.6%. Between July and September 2025, Beijing added about $2.2 trillion in government debt, which was a smaller increase compared to the US, where the number rose by $2.9 trillion during the same period. China also holds around $800 billion in US treasuries, a position that quietly became leverage in recent trade negotiations over semiconductors and electric vehicles. On the surface, it looks like the US is the heavy borrower and China is the disciplined saver. But that's only part of the story. When you include everything, government, corporate, household, and hidden local debts, China's total non-financial debt reached 336% of GDP in the second quarter of 2025, according to an October 21 analysis by Bloomberg. In other words, China's total debt is about 2.7 times the US level, the highest it has ever been, and it's still growing despite tighter financial rules. This debt buildup comes from years of aggressive infrastructure spending and local government funding gaps. In this video, we'll break it down step by step: how local officials' incentives started it, how local government financing vehicles LGFVs became the main driver, how the real estate sector deepened the problem and led to deflation, and what the Evergrande collapse means today with new October 2025 updates. We'll also look at how debt swaps are helping to stabilize the system and what lessons this holds for the US. All insights come from the IMF's October reports, Bloomberg's October 21 LGFV analysis, Fitch's October 14 assessment, and Reuters' October 20 update on Evergrande, connecting the dots with US parallels like the municipal bond market and the 2008 subprime crisis. According to the International Monetary Fund, IMF, China's government debt stands at 88.3% of GDP, up from 84% in 2024. Still below the US and far from Japan's 236.6%. On paper, that looks manageable, especially for a country that's built 45,000 kilometers of high-speed rail and added over 1,000 kilometers of metro lines in 2024 alone. With debt under 90%, it seems like China has room to keep building. But the broader picture tells a different story. China's total non-financial debt, including government, corporate, and household borrowing, hit 336% of GDP in mid-2025, a record high according to Bloomberg's October 21 report. Local governments are a big reason why. They handle around 85% of public spending but keep only half of the tax revenue, relying heavily on land sales for income. That model is now breaking down. Land auctions, which once made up 40% of local budgets, have fallen 20% this year, leading to delayed salaries for civil servants and protests in cities like Shanghai and Guangzhou. To cut costs, many areas are slashing public events and maintenance projects. And then there's overconstruction, the clearest sign of China's debt trap. More than 50 ghost cities now sit half-empty, from Ordos and Ujiapu to Zhengzhou and Tianducheng. These billion-dollar projects were built for millions of residents who never came. Today, they cost hundreds of millions a year to maintain but generate almost no revenue. In total, China's empty housing stock is estimated at 65 million units, enough to house twice the population of France. Together, these ghost projects and local shortfalls have piled into a massive $60 trillion debt load, showing how unchecked local borrowing turned ambitious development into long-term financial strain. China's system turns economic growth into a promotion path for local officials. Every year, the central government sets a national GDP target, which for 2025 is 5% as announced during the March 2 sessions. But for ambitious provincial and city leaders, just meeting that goal isn't enough. They have to exceed it, often aiming for 6.5% or higher to get noticed in annual party reviews. That small difference can decide whether someone stays in an inland post like Hunan or moves up to a powerful coastal province like Guangdong, or even earns a policy role in Beijing. In short, hitting the target keeps you safe, beating it moves you up. Since local governments can't borrow directly and only retain about 50% of their tax revenue, they've developed creative ways to fund growth. The most important of these are local government financing vehicles, LGFVs, companies that are technically private but controlled by local authorities. They borrow money and invest in projects on behalf of the government, keeping much of this activity off official balance sheets. A typical cycle looks like this. A provincial leader reviews Beijing's target and sets a higher local goal. The city identifies valuable land, often worth billions, and leases it cheaply to an LGFV. That vehicle then uses the land as collateral to secure loans from state-owned banks, such as ICBC, usually at favorable rates. The borrowed money funds construction projects like highways, bridges, industrial parks, or tech hubs, which create short-term economic boosts and jobs. Once completed, the projects raise local GDP just enough for officials to meet or surpass their growth goals and get rewarded. This system exploded after a 2008 stimulus when Beijing encouraged local spending to sustain growth. By October 2025, LGFVs collectively held about 60 trillion yuan, $8.4 trillion in debt, roughly half of China's GDP. According to Bloomberg's October 21 data, there are now more than 300,000 LGFVs across the country. While new borrowing has slowed under tighter rules, costs remain high and many older vehicles are being shut down to clean up balance sheets. Unlike the US municipal bond market, where state and local debt is transparent and regulated, China's LGFV system operates in the shadows. It fuels growth but also hides risks, allowing debt to build faster than the economy itself. Some analysts warn that if growth slows or investor confidence slips, this model could trigger a serious debt crisis, what economists call a Minsky moment. Local government financing vehicles, or LGFVs, became the main financial engine behind China's construction boom. Between the late 2000s and early 2020s, nearly half of their spending, around 40 to 50%, went directly into real estate projects. That huge flow of money pushed housing's share of China's total GDP to almost 30%, roughly double that of the United States, where the housing sector stays near 15% and grows only when demand truly exists. But why did so much Chinese money end up in property? The reason lies in the country's saving habits and lack of safe investment options. Chinese households save more than 30% of their disposable income, one of the highest rates in the world, yet their choices for investing that money are limited. The stock market, for example, has barely rewarded investors. Since 2000, the Shanghai Composite Index has risen just 100%, while the S&P 500 in the United States climbed more than 300% in the same period. Even worse, during the last decade, US stocks rose another 150%, but China's market actually lost value after inflation, largely because of heavy government interference. The 2015 stock market crash triggered automatic circuit breakers that froze trading more than 5,000 times, shaking investor confidence for years. Bond markets didn't help either. China's 10-year government bond yields have stayed near 1.7%, about half the return of US Treasuries. While strict capital controls limit how much money can leave the country, ordinary citizens can move only $50,000 abroad per year, and large institutions face even tighter scrutiny. With few profitable choices, families turn to property as the only asset that seems safe. By 2020, Chinese households had tied roughly 70% of their total wealth to real estate. Prices looked unstoppable, and easy policies like lower down payments made it feel risk-free. But behind that boom, demand was already slowing. LGFV-backed developers started building in remote or speculative areas where almost no one wanted to live. That's how China's ghost cities were born. The most famous one is Ordos's Kangbashi, launched in 2004 with a $10 billion plan to create a futuristic city for 1 million residents. It has wide roads, artificial lakes, a massive 420,000 square meter library, and even golf courses. But after 20 years, it's still about 90% empty. Maintenance alone costs roughly $500 million a year, and because so few people live there, there's no local tax base to support it. Another case is Yujiapu in Tianjin, launched in 2010 as Manhattan East. It copied New York's skyline, even replicating the One World Trade Center tower. The total investment reached $20 billion, but today, it stands mostly deserted, losing about $500 million each year in maintenance and security as dust storms and vandalism take over. Zhengzhou's future city, meant to be a $15 billion shy-tech business district, now sits half-built, with 80% of its buildings unused and weeds growing through empty plazas. Tianducheng, a Paris-themed suburb in Hangzhou with a $1 billion budget, built a 354-foot Eiffel Tower replica and 10,000 French-style apartments. Only about 2,000 people live there, most shops are closed, and fountains have run dry. Local media estimate over $100 million lost in upkeep since 2015. These examples are just a few among more than 50 similar ghost cities across China. Each cost billions of dollars and remains over 70% vacant, creating a massive housing surplus. About 65 million empty apartments as of late 2025. That's enough to house the population of France twice over. The United States faced its own real estate bubble in 2008, but key differences helped it recover faster. U.S. housing construction usually follows market demand, and regulations, like FHA appraisals and local zoning limits, keep oversupply in check. When the bubble burst, around 2 million homes went into foreclosure, but transparency through public listings allowed prices to adjust quickly. Within 5 years, property values rebounded by about 50%, supported by the Federal Reserve stimulus programs. China's situation is much tougher. Home prices have already dropped around 15% since their 2021 peak. Youth homeownership in major cities has fallen below 80%, and many young couples are delaying marriage because homes have become unaffordable. This housing slowdown has spilled into the broader economy. Consumer prices have barely moved for more than 2 decades, leaving China stuck near zero inflation. Despite producing 30% of the world's goods, China's domestic consumption remains just 39% of GDP, far below America's 68%. That weak spending means businesses see little reason to expand or hire, trapping the economy in a low-growth loop. People keep saving, but money circulates slowly. Meanwhile, the US, with moderate inflation of 2 to 3%, keeps its economy moving. People invest, spend, and generate returns that fuel the next cycle. Evergrande lit the fuse back in 2021. It was China's biggest property developer, carrying more than $300 billion in liabilities, much of it borrowed through local government financing vehicles. When it defaulted on $82 million in interest payments, panic spread through the entire real estate sector. Land sales, the main source of income for local governments, collapsed by nearly 50% in 2022, cutting off a vital cash flow. LGFVs struggled to roll over their debts. Housing prices dropped about 15% nationwide, and around 10 million buyers were left trapped in half-finished apartments or negative equity. By late 2023, total property debt reached an estimated 66 trillion yuan, and the crisis only deepened. In August 2025, Evergrande was delisted from the Hong Kong Stock Exchange after repeatedly missing restructuring deadlines. The largest delisting ever by volume, according to Reuters. Liquidators from Alvarez and Marsal soon launched offshore investigations to recover around $6 billion, including assets of founder Hui Ka-yan, after court filings in the Cayman Islands uncovered hidden transfers worth $2 billion. Even Evergrande's $32 million superyacht, called Event, was sold off in a forced auction at barely 2/3 of its cost, a symbol of the company's desperate liquidity squeeze. Foreign investors, who once saw Chinese property as a safe bet, are now taking heavy losses. Global funds had poured roughly $140 billion into China's real estate sector, with major players like BlackRock and Carlyle Group leading the charge. But many of those investments are now being sold at 30 to 50% discounts. As vacancy rates climb, Beijing offices sit a quarter empty, and Shanghai retail spaces are down by about 15%, according to JLL's October report. Out of China's 30 major defaulted builders, 8, including Evergrande, now face full liquidation orders per S&P's October data. Sunac China, another large developer, managed to push through a restructuring plan, but even it had to accept a $9 billion debt write-off. Losses have narrowed slightly this year, hinting at partial stabilization, but the broader slowdown continues. By the third quarter of 2025, new home starts were down 25% year-on-year, and October saw the sharpest price drop in nearly a year. Economic growth slowed to 4.8%, the weakest quarterly performance yet and below Beijing's 5% goal. Youth unemployment hit 20% mid-year, exports fell 5% under new U.S. tariffs on steel and electric vehicles, and Goldman Sachs estimated the impact shaved about 0.3 percentage points off annual GDP growth. The parallels to America's 2008 subprime crash are striking. Back then, the U.S. government injected $700 billion through TARP to rescue banks, and although millions lost their homes, recovery began within 3 years thanks to transparency and swift policy action. China, however, faces a deeper challenge. Its property sector alone makes up 1/4 of its GDP, and opaque accounting means problems surface slowly. Foreign investors have already pulled out $50 billion from property-linked exchange-traded funds this year, according to EPFR, while Moody's warns that continued defaults could spill over into China's broader sovereign debt if local governments start failing to pay. So far, China has managed to keep the crisis contained, thanks to debt swaps. The program, launched in late 2024, converts risky local government financing vehicle loans into official government bonds with longer terms and lower rates. Think of it like merging 5 maxed-out credit cards into one manageable loan. By June 2025, about 3.8 trillion yuan worth of these bonds have been issued, cutting average borrowing costs by roughly 2.5%. According to SCMP, lawmakers later expanded the quota to 12 trillion yuan through 2028, with 1 trillion set aside for struggling provinces like Guizhou and Yunnan. The People's Bank of China, PBOC, directed banks to extend most local loans at reduced rates, which helped boost debt servicing capacity and clean up balance sheets. Over 1,200 LGFVs were shut down in 2025 alone, removing nearly $500 billion in bad debt. While China still faces around 10 trillion yuan in repayments by 2026, the swaps have stabilized things. New local bonds now yield around 4%, down from 7% earlier, and analysts at Nomura say debt sustainability has improved by about 15% for swapped entities. Behind it all, money supply M2 keeps expanding, up 16 times since 2000 compared to the US, merely tripling. Yet, inflation stays low, partly because Chinese households save more and spend less, with consumption only 39% of GDP versus 68% in the US. Most savings still flow into property or low-yield bonds, as volatile markets and strict capital controls limit investment options. China's large state-owned assets also act as a safety net, estimated at over $40 trillion in total value, from urban land and industrial firms to utilities. That gives Beijing room to raise funds, such as by selling small stakes in major state companies for short-term relief, without resorting to harsh austerity measures. China's 336% total debt is testing its limits, but recent debt swaps and state assets are giving the country some breathing room. According to the IMF's October forecast, China could still grow around 4 to 5% in 2026 if its property market stabilizes, though Goldman Sachs warns tariffs could trim about half a percentage point off that growth. Here are 3 takeaways for us. First, always test demand before funding big projects. China's ghost cities like Ordos wasted around $10 billion each. The US has its own version, California's $100 billion high-speed rail, 20 years delayed with 0 miles open, or the $3 billion Hudson tunnel still stalled. Projects should fit real population and economic needs, not just political headlines. Second, prioritize transparency. China's $60 trillion in hidden local government financing vehicle debt went unnoticed for years. In the US, quarterly SEC filings and municipal bond disclosures caught early signs of issues like Enron and Detroit, helping keep yields low and preventing $2 trillion in hidden risks. Third, align incentives wisely. China's growth targets encouraged overbuilding for promotions. The US can learn from that by focusing incentives on jobs and innovation instead, like the Inflation Reduction Act's $370 billion in clean energy credits, projected to create 2 million jobs by 2030, instead of short-term GDP spikes that led to bubbles such as the 2021 SPAC craze. China's slowdown could make our imports cheaper but also threaten supply chains. US companies like Apple could face up to 10% higher costs if disruptions spread. Debt swaps may be a long-term win for China, but only time will tell. If this breakdown made the October updates clearer, don't forget to like, subscribe, and turn on the bell. Thanks for watching.